This is Janus Dispatch, Architecture over Narrative. Dispatch 3 in the Rented Deflation series. From renting to owning on Flare. How to get from rewarded Flare-funded TVL to activity-funded yield. A dispatch on FLR tokenomics. It works as its own blade. No prior reading required, though it carries spectra on Flare and rented deflation on Flare forward. Rented deflation diagnosed the architecture. The supply math has been fixed, the demand side has not. Capital flows where the rewards point, the rewards flow from emission, and the fees that close the deflation loop depend on activity that emission itself recruited. Strip the subsidy and the picture changes shape. From renting to owning is the prescription that follows. Not a critique of FIP 16, but the next architectural question it leaves open. If the deflation loop needs organic activity to fund itself, the question is what creates that activity? The demand stack is the answer this dispatch makes. What the subsidy is actually buying. Today, the rewarded Flare subsidy buys liquidity provider presence, mercenary capital arrives, parks, collects, exits, total value locked rises on dashboards, and the chain looks active. But the activity that fee burns and fire buybacks depend on is borrower demand, underwriter demand, hedger demand. The supply-side subsidy does not produce that. It produces the opposite. It produces the conditions under which demand-side capital has no reason to arrive. That is the rented deflation dynamic in operational form. The subsidy creates the optics of activity without the substance of it. FIP 16 built the engine. The demand stack would build the fuel. The demand stack, 3 gears. The first gear is duration. Fixed rate, fixed term, defined collateral, predictable liquidation boundary, the 4 properties that turn a DeFi loan from an open position into a financial instrument a treasury can sign for. The architecture for this is built. Morpho Midnight, whose white paper Morpho Association, published in May 2026, organizes lending around isolated, immutable, permissionlessly created, and fixed maturity markets. Lending and borrowing happen as the trading of credit and debt units whose payoff structure is zero coupon. Positions settle at the market's fixed maturity with no rolling tenor and no oracle dependency for rate setting. The implied rate is whatever the market clears at, derived from the price at which units trade. Capital knows in advance what it will pay and when. The scale of institutional demand for this primitive is no longer theoretical. On June 2, 2026, Morpho announced a $175 million raise co-led by Paradigm and a 16Z crypto with $11 billion in current deposits via DeFi and what Morpho frames in its own pitch as a $200 trillion addressable global credit market. Fixed-term lending is the demand-side infrastructure for the next phase of on-chain credit, and capital is being deployed to build it. What that capital validates, the demand side is real and well-funded. The question for each chain is whether the venue exists to receive it. 2 of Midnight's design choices matter directly for Flare. Maker callbacks let the capital backing an offer stay deployed productively elsewhere until the offer is taken. Liquidity is not locked across markets, which means the demand stack does not need to compete with fire incentivized pools for idle capital. Permissionless market creation lets anyone deploy a new, fixed maturity venue without foundation approval. That keeps the architecture an ecosystem layer rather than a foundation product, and it fits the allocation choice this piece is about. Calendar date maturities make positions opened at different times with the same maturity fungible, which prevents the liquidity fragmentation that hurts isolated markets in practice. The same primitives are portable to Flare's EVMC chain. Active on-chain lending across EVM ecosystems totals about $25 billion as of May 2026. The demand-side capital exists. It is not on Flare because the venue to receive it has not been built yet. The subsidy budget that today recruits liquidity providers could equally well subsidize the first wave of fixed-rate borrowers and the builders writing the duration markets they borrow in. Capital that arrives this way borrows because the product is useful, not because the yield is paid. One discipline matters here. The borrower-side subsidy must function as cold start ignition for order book depth, not as a recurring yield stream. A subsidy that pays borrowers in perpetuity reconstructs the same mercenary dynamic on the demand side that this piece argues against on the supply side. The subsidy ends. The product remains. Field check, June 21st. Spectra has activated the August 27 and November 26 staked XRP pools as the post-June 4 rollover targets, exactly where the 2 times Firelight points pre-activation pointed 19 days earlier. TVL splits 62 to 38 across the two, with roughly $6.78 million of the original $8.69 million staying in the system after rollover. That is the first observable 2-point curve formation on Flare. Not full duration depth, but no longer a single magnet point either. The 60-day window that will start post-Phase 2 launch is the test. As of July 4th, Phase 2 has not launched, so the clock has not started. If a third or fourth maturity activates with substantive TVL, the curve formation thesis is confirmed. If the structure compresses back to single pool concentration, the rented TVL diagnosis from the May 29 essay holds as durable, and the demand stack stays a foundation choice rather than a market outcome. The second gear is insurance. Once borrowers exist, underwriting becomes possible. Cover markets, default insurance, parametric risk coverage, Oracle failure protection. These products generate premium income from real risk transfer, not from emission. Underwriter capital looks different from LP capital. It stays because the premium is paid out of usage, not out of issuance. Firelight's Phase 2, scheduled for Q2 2026, is the most visible foundation-adjacent test case in this category. If it ships on time and the first cover product clears within 60 days of launch, the insurance gear is forged and the thesis takes a real step toward validation. Beyond the gear itself, one property of how insurance is implemented on Flare matters for the demand stack thesis. The underwriter capital can be the network token itself. Both FLR posted directly as staked Flare and S-Flare posted as staked S-Flare can serve as collateral for cover markets, with each layer of yield priced as a layer of accepted risk. A staked Flare underwriter earns the cover premium and assumes the obligation to pay claims when a covered protocol is exploited. A staked S-Flare underwriter stacks the staking yield from SEPTA and FTSO delegation on top of the cover premium, with the corresponding stacked exposure. PT, wrapping either position, fixes the rate and embeds an underwriting tail inside what looks like fixed income. The composability is real the moment Firelight's underwriting layer goes live. That composability matters for the thesis in a specific way. When insurance underwriter capital is a Flare-native asset rather than imported stablecoin or wrapped Bitcoin, the gear produces direct demand for the network token. The foundation's allocation choice is no longer only about subsidizing builders. It can be structured to make the chain's own token productive as collateral in the venues those builders create. Rented deflation diagnosed that today's FLR holders pay for the subsidy by bidding into the fire buyback. Productive collateral closes that loop. The same token whose deflation FIP16 wants to enable becomes the asset that anchors the underwriting layer, and the demand for the token comes from the gear rather than from the marketing of the gear. One honest caveat is built into the same mechanic and deserves equal billing. rFLR underwriting. FLR native protocols is the system insuring itself. For idiosyncratic exploits such as a single protocol bug or a single Oracle misfeed, the architecture works as designed. A claim is paid from collateral that remains intact through the event. For a systemic FLR event, the collateral crashes precisely when claims spike and correlation runs to 1. The Firelight Risk Consortium's payout waterfall provides one structural shield against this. Claims first draw from a stablecoin buffer layer before any collateral slashing engages. That buffer absorbs idiosyncratic events without forcing correlated collateral liquidation. It does not eliminate the systemic event tail. It pushes the depositor risk to where it belongs, beyond the buffer. The architecture remains real. The tail has to be priced for it, and the discount cycle has to compensate the depositor for taking concentrated chain-level exposure. One question follows directly from this architecture and remains open as of July 4th. Is FLR or rFLR explicitly in Firelight's Phase 2 collateral roadmap? The Risk Consortium announcement of June 2nd stated, quote, BTC support planned through partnership with Lombard and additional collateral assets and strategic integrations to follow, end quote. It did not name FLR or rFLR. That clarification is the activation marker for the native token productive collateral path. The architecture works either way. The question is whether the Foundation and Firelight intend to use it. The third gear is the options market. Vol yielding and derivative deep. Once borrowers and underwriters exist, both need hedging. Borrowers want to protect against rate moves and collateral drawdowns. Underwriters want to manage tail exposure on the coverage they sold. Market makers and hedgers arrive because their counterparties exist, and they bring with them the liquidity that makes the first two gears tradable. Without options, duration is exposed and insurance is blind. With options, both become positions a sophisticated balance sheet can carry. A working draft of one such venue is already open. The RFP for native options on FLR, covered calls, and cash-secured puts for FLR and FXRP, FTSO priced, and F-asset native, no bridging, sketches the business case, the spread mechanics, the smart contract architecture, and the curated vault distribution layer that connects to the insurance gear above. Section 11 lists the 12 scenarios that would kill the project. Pull requests welcome as proposals. Critique that breaks any of the 12 is the contribution that matters most. The repository is at github.com/janus-watcher/rfp-options-FLR-native. None of these gears is novel. All three exist in traditional finance and in the more mature corners of crypto. What is missing on FLR is not the architecture. It is the demand-side capital those architectures attract. The same rewarded FLR budget that today buys mercenary liquidity could subsidize the builders writing these gears and the first users who exercise them. Subsidy as ignition for organic demand instead of subsidy as ongoing tribute to mercenary supply. Why it becomes a flywheel. The three gears are not three separate bets. They are an interlocking system. Each gear lowers the activation cost of the next, and the system accelerates once any one of them runs at scale. Start with duration. The first cohort of subsidized fixed-rate borrowers generates interest payments. These are VNet-conforming external fees in Luo's framework, not emission circulation. The fees are small at first. They are also real. They prove the architecture. Borrowers exist when the product makes balance sheet sense for them. The proof reduces the perceived risk for the next cohort, who arrives without subsidy. Borrower presence creates the conditions for underwriting. Now insurance has something to insure, premiums to collect, capital that pays for coverage rather than chasing emission. Underwriter capital is patient capital. Once it arrives, it stays through cycles because the income source is durable. Their presence, in turn, signals to options market makers that the trade flow is real and the venue has structure. Vol liquidity arrives, and with it, the ability for borrowers and underwriters to manage tail risk. Each layer makes the layer above more attractive and the layer below more sustainable. Once the stack rotates on its own torque, two things happen. The fees via captures come from organic activity rather than subsidized circulation, which means the deflation FIP16 promised is finally route admissible in Luo's sense. The fee stream actually carries the buyback, and the subsidy itself becomes optional. Foundation capital that today is permanently allocated to LP recruitment can be redeployed or held in reserve for the next architectural push. The subsidy ends because it succeeded, not because it failed. Foundation's allocation choice. Flare's foundation has built the harder layer first. Core network engineering, TEE infrastructure, FCC, cross-chain bridges, FBTC architecture. These are the components that make any of the above possible. That work continues, and it is the right work for a foundation to do. Application layer products are not foundation domain, and they should not be. What foundation does control is the subsidy budget, and the subsidy budget is the single largest ecosystem-shaping instrument on the chain. On June 2, 2026, in the Inside XRP on Flare stream, Hugo Fillion put the dynamic into foundation-side language. Quote, "There's organic yield, there's some inorganic yield as well. Now it's really time to consolidate and grow that." End quote. That is acknowledgement of the precise transition this piece is about. The supply-side roadmap Hugo outlined in the same stream: more stablecoin liquidity, deeper institutional XRP partnerships, RWA trials via FCC, Flare as cross-chain data layer is one side of that transition. The demand-side primitives this demand stack identifies are the other. Both are needed for inorganic to become organic. The question is not whether to spend the budget. The question is what the spending buys. Today, it buys LPs. The demand stack thesis is that the same capital redirected to subsidizing the builders of duration markets, the first cohort of institutional borrowers, the underwriters writing coverage products, and the market makers seeding option books, would buy a different outcome, one that compounds where the current allocation only persists. Hugo Fillion is the CEO of this allocation choice. He has built core infrastructure that most chains do not have, and he has the capacity to read this trade-off in detail. This piece is not a prescription for his desk. It is a map of the choice his desk is already weighing. The operative posture, either way, is concentration. Spread subsidy across many pilots, and the leverage dilutes. Focus it on a small number of high-leverage gears, and the leverage compounds. The variable is which gears. One 24-day data point shows the duration gear's demand side surfacing in real time. Between May 28 and June 21, the wrapped flare September 30, 2026 SEPTA pool moved from 14.78% fixed APY to 7.17%, with TVL holding at roughly $1 million. On Spectra's Pendle-style mechanic, that compression is not a foundation subsidy cut. It is the market. Participants are buying PTs, actively eating the spread, and accepting lower returns for the security of duration. Liquidity didn't stay because it was loyal. It stayed because duration anchored it. This is the first observable sign of organic demand for the duration gear itself over the same 24-day window in which the staked XRP curve activated. Firelight as the first live test. Firelight is the most visible foundation-adjacent attempt at the insurance gear today. Phase 1 went live December 3, 2025, with XRP liquid staking via F assets. The public roadmap commits Phase 2 to Q2 2026. Maturity tracking, underwriting engine, cover products. That gave a hard deadline of June 30th, 2026. As of July 4th, that deadline has slipped without a Phase 2 announcement. The slip itself is the first data point for the demand stack thesis on Flare. The ecosystem that promised Phase 2 in Q2 did not deliver on schedule. 3 outcomes were possible at the June 30th deadline, each diagnostic. If Phase 2 shipped on time and the first cover product cleared within 60 days of launch, the insurance gear was forged and the thesis took a real step toward validation. If it shipped with marketing momentum but limited operational substance, the gear existed in form rather than in function, and the thesis was falsified for that gear. If the deadline slipped, the question shifted from, does this gear work, to can the ecosystem that promised it deliver any gear at all? The deadline has slipped. The next observable is the announcement itself and the 60-day window that will start when the launch does. The question the piece stayed with, the one that opens the rented deflation section, does not depend on that timing. Firelight is one example of the insurance gear, not the only possible implementation. The demand stack thesis is protocol agnostic. What matters is whether the architecture for underwriting risk transfer exists somewhere on Flare and produces premium income from real coverage, not whether any specific protocol earns the role. The bet. Smart money sees the missing gears. Lending on Flare today is open-ended position-taking rather than structured borrowing, and options are absent, which means hedging is unavailable. Underwriting has no premium income because there is no coverage market to write. These are operational reasons capital does not arrive at scale. The conclusions get priced eventually. The question is when and by whom first. Janus's position is not to make the allocation decision. It is to make the lens visible before the market does. If the demand stack thesis is correct, the chains that build these gears first will inherit the institutional capital that today sits in treasury bills, waiting for crypto credit infrastructure that can be signed for. If the thesis is wrong, the watcher will say so when the evidence appears. That is the discipline. Diagnose, then verify when the evidence arrives. 2 hard deadlines anchor that verification. The demand stack flywheel has 18 months from foundation reallocation to show ignition. If it does not ignite in that window, the spec is structurally wrong. The foundation has 24 months from today, July 4th, 2026, for organic fees to overtake the rewarded Flare subsidy outflow. If the line does not cross by then, the prescription is wrong in its current form. The options gear, rFP, linked above, is the same posture in concrete form, a document built to be falsified, not defended. FIP 16 fixed the supply math. The demand stack is what would make that math route admissible. The foundation has the budget and the mandate to choose where the next leverage point sits. The instrument to watch is Firelight's Phase 2 launch, now overdue since June 30th. The delay itself is the first observable. The first cover product clearing when the launch arrives is the second. The litmus stays the one that opened Rented Deflation. Remove the subsidy, does the activity stay? Until that test resolves in either direction, deflation remains a hypothesis dressed as a mechanism, and the answer is built one gear at a time. That was Janus Dispatch. Sources, charts, and disclosure are in the published post. Firelight's Phase 2 deadline slipped on June 30th. Next dispatch in the series picks up when the launch arrives and the 60-day window starts. Until then, the architecture stays visible and the data does its work. If this dispatch sharpened your read, subscribe so the next one lands in your inbox. Janus Dispatch is at janusthewatcher.substack.com. Janus also runs one-on-one confrontation. 60 minutes, one decision, no follow-up. For people who carry responsibility and want their thinking taken apart before it costs them. One sentence is enough. Details on the confrontation page at Janus Dispatch. The long arguments are in the books. The transition sequence, 2 volumes, 1 thesis. The ground is shifting. Book 1, The Proto-Post-National Age. Book 2, The Frame. Available on Amazon, paperback, and Kindle. The dispatches connect. The books carry the weight. Architecture over narrative.